Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
Quiet and distant is always how I describe Ed Barton. My goodness. Definitely not foghorn and what is the opposite of distant?
Foghorn. Foghorn.
Nearby? Engaged? All right.
Locked
Here we
in.
go. Locked in. We are locked and ready to go on the Private
We are
Equity
locked
Experience
in.
podcast. And
We are.
our kickoff question, I'm gonna go to Rory. Rory,
Yes.
when you used to drink, at least more than you do now, would you
Yeah.
go for the strong shot that burns or a watered down cocktail that lasts all night?
Oh, I think you know the answer to that. I'd go strong and hard hitting quickly, generally speaking. Yes. Yeah. Very much used to be a whiskey guy. So, the higher the proof, the better back in the day. Yeah, definitely.
Rory
No
may or
watered
may
down.
not have drank to the point of like lights out
Oh yeah.
nights.
A
Yeah.
few times. More than a few times. Yeah. Yeah,
Mr.
when I was
Bart,
much younger and had a little more constitution, now that'd be a real problem for me.
would you be down for the count for like days if you did that?
Yeah. Yes. Yeah, the hangover effect is really a deterrent for me in so many
Yeah.
ways of consuming alcohol. Yeah.
Edward Barton, is
Yo.
there any car fluid that actually gets better when you dilute it? Or is it always a bad idea or a last resort situation?
Oh my gosh.
Any car fluid that gets blinker fluid gets better when you dilute it.
Oh,
I didn't know there was such a thing as
me
blinker
neither. Are
fluid.
you making
Probably
this up?
isn't actually.
God bless. Blinker fluid. What the hell?
Yeah.
All right.
Yeah.
Generally,
that's classic.
nothing gets better diluted, whether that's the whiskey or the car fluid or your cap table.
Or
Okay.
cap table. See, exactly.
Let's get
right.
into our topic for today,
Yeah.
which is investment dilution. So let's start with like a basic definition and example. So company issues shares, their initial round of shares. Subsequently, company issues additional round of shares. Therefore, if you owned a certain amount of shares, you now own a smaller percentage of the company. Is that
Yeah.
a working definition?
Yeah, I mean, in that exact way of stating it, that's right. Yeah, if you have the same number of shares and the company issues more shares to other people, then you own less of the company by virtue of having a proportionally less piece of the pie. That's the way to think about it. Is
Okay.
if you have a bigger slice of the pie, and more pie is somehow created and given away, then you have less than you had before. Yeah. And that's generally not a good thing. I mean,
No.
and, I'd say categorically speaking, dilution isn't good generally.
Yeah, the argument is always made that it's like, well, you got a smaller piece of a bigger pie.
Exactly.
But that bigger pie and that smaller piece might not be the right kind of split for you. You might be hungry
Yeah.
with that split.
So we alluded to this in our last podcast episode where we were talking about the cap table and debt and equity and mezzanine and all that good stuff. And we were kind of going through the sequence of this stuff. And you two were both mentioning, and at this point you get diluted. And at this point, the original investors would get diluted. So we thought this would be a good topic. But where does
Yeah.
this come into play in real life for investors, for PE, for VC funds? We've kind of talked about a whole bunch of these things.
Well, I'll tell you where it doesn't come into play, which is a really good place to be if you can manage your way through it, is to bootstrap your business so that you're not giving away pieces of your company to take on outside capital. Like, so your business, for example, Emily, you haven't taken on other investors, so you own all of your business. Therefore, you're not experiencing any dilution, and presumably never will, which is the way to be. And there are a lot of examples of that out there where big companies that you hear about today that have been around for a long time, they've just never taken on outside capital because, they've had, growth and profitability out the gate, and they've never had to do it. And I think really that comes down to the choice to take on external capital, take on other business partners, raise more money, equity specifically. That's where you have to decide whether, it's worth it to be diluted or give up part of what you've built and, give that away forever, basically, unless you buy it back someday. But,
when would you have to make that decision?
Well, a lot of companies look at it when they're close to running out of capital. That's usually a place where you pretty much your hand is kind of forced and say, darn it, I'd love to bootstrap this thing, but I can't. And so I need to go ahead and take on an investor. And I know I'm going to have to give up a pound of flesh for that, proverbially.
The worst time to get money is when you need it.
Exactly right.
It doesn't matter whether that's debt or
that
equity.
Is exactly
right. The worst time to get money is when you need it, because then you lose your negotiating leverage.
Yeah.
So dilution, in some cases, I agree with Rory in a general sense, in that if you can bootstrap your business to the point where you can sell it and do that without taking external money, more power to you, and that's going to be your best choice to achieve, if that's your strategy and that's what the goal you want to achieve. Most businesses that, if you look at a Facebook or you look at, even most of your public businesses, they haven't been bootstrapped. They've had folks come in, and each round that folks come in, the leverage changes depending on how successful the business is. So you could go, if you have a really successful business, you can go out and raise capital, and actually it's going to cost the investor a lot. And so the dilution is going to be less. Really, the goal is always go out for capital when you don't need it, and always have an overperforming business so that you can have a beauty contest and a competitive environment for your capital round. And if you're not, if you're out there like hat in hand, begging for your capital, that's when you're going to get that's when the dilution is going to make that cheap cocktail you talked about really bad.
What did you mean? What did you mean when the investor has to pay for it?
Well, it just means if you have, we'll use a real example here. Amazon, Jeff Bezos is largely thought of as pretty savvy business person, because whenever he had taken on new money, external capital, like what Ed's saying, it was when there was a lot of demand to be part of that growth journey. So when an investor is trying to get into like a hot stock or something like that, you end up paying a premium for that. And the same thing goes in private businesses where you're issuing private classes of shares, which is to say, if you have a lot of demand lined up, you can dictate the terms to the investors for which they come in. So you might give up a very small slice of your company to take on a lot of money.
Okay.
On the flip side, the opposite of that, what we're talking about, where it's bad, is if you need the capital and the investor knows you need the capital and that they're the critical path to that, then you might have to give up a lot of your company to get the kind of capital you need to keep growing the business. And not only beyond the financial aspects of owning less of your company, of course, there's also control aspects. You want to, as a founder, management team, what have you, maintaining as much of a control position as possible. And that's generally based on the proportion of the company that you own. You get to be more of the decision maker. You get to be more in control of the board seats, things like that. Mark Zuckerberg is another example of somebody that's managed to do that very well over time. And that's a function of what we just talked about was, that's a company that everybody wanted to be part of. And so, they get to pick and choose the investors they bring in and dictate the terms to the investors. And probably most of those investors are pretty happy right now if they came in early on that business, no matter what the terms were that they had to sign up for.
If a founder, can a founder do anything at the beginning to prevent their shares from being diluted?
Yeah. And I think one of the things Rory talked about with Zuckerberg was they had multiple classes of stock.
There you go. Yep.
So there's founder shares,
Yep.
which have like one share gets 40 votes.
Right.
And then there's the investor shares where one share gets one vote.
Yeah.
And so even though the founders may have diluted themselves to 30% of the ownership, they still have a majority or a super majority of the voting interest so that they can control the board of directors. They can control they maintain that control that Rory was talking about. Now, you're going to trade, when you do that, you're going to trade generally for value. So there's going to be a cost associated with setting some of those things up. But the key thing that a person can do, or that a founder can do, to actually prevent themselves from being diluted is to have an overperforming business and have a strong competitive fundraising round where you've got multiple players, because those multiple players will go, I want in.
Yeah.
I'm going to value your business at $100 million. And then the next one goes, I'm at 110, or I'm at 120, or I'm at 130, and you get super majority voting interest. And so you drive that, and that's where your investment banker also is going to be able to kind of bring their forces to bear if they're worth their salt to make sure you get that maximized.
Yeah. And the reason why this sort of delineation of slicing the pie comes into play so much with earlier stage businesses, rather than, let's say, a private equity company coming in is really, generally speaking, when a private equity company mostly comes into the picture. I shouldn't say mostly. In a lot of cases, they're buying the entire company. So it's like, look, you're just basically saying, okay, I want the max value for my business, and I'm going to have a competitive process to get that max valuation. In a case like this, oftentimes earlier stage businesses are selling off minority pieces of their business, but they want to maintain as much of the pie as they can for how much they're selling, how much money they're raising. They want to give up as little as possible. In the case of the private equity game, it's more like I already know I want to sell 100% of my company. I just want to get the max value for that.
Okay. So what about when a private equity company sells to another PE company? Does the first PE company's shares get diluted?
No, and you don't tend to see that. It tends to be a full sale, like Rory said. But where you do see that is on the venture side.
Exactly.
Where you have venture round A, might have a smaller venture capital firm that's backed it. And then you've got to go, oh crap, it's a good problem. We're growing so rapidly that we need to go out and raise additional rounds. And instead of going to a small venture fund, we're going to go to Madrona, or we're going to go to Kleiner Perkins, or we're going to go, one of the big boys. Well, those big boys are going to come in and they're going to dilute the folks in round A, because you're getting additional money comes in. So the pie gets bigger. Like these guys go, well, I'm going to write a check for $1 billion, but that $1 billion isn't going out to the other shareholders in normal cases. It's going into the business. And so the business has a pre-value, which is set, and then it has a post-money value, which is the value of the bigger pie plus the opportunity cost, plus the growth opportunity that's built into that additional money. And that's where your negotiation is what's my pre-money value, what's my post-money value, and how much of that post-money value do the original shareholders, do the shareholders before that round hold? Because they're going to get diluted with that in that post-money scenario.
Yeah.
Yes. Okay. So it might happen more commonly in the VC rounds, but we did mention last time that one of the exit strategies is to sell to a PE firm, and that's in our book. So in those situations, is it like they're just buying the whole thing again, so it doesn't really matter?
Yeah, exactly.
Normally the original PE firm, unless they do a sidecar or something along those lines, which again is more like a VC where the original fund is going, we still want to come in, but we want additional equity. They may not be in a position where that fund has additional equity to contribute, so that private equity fund is kind of tapped out, or they're not making new investments. They're returning capital to shareholders. They want to, or to limited partners. They want to be able to make an additional, or that business needs additional capital. They may have a second private equity firm come in. At that point, and it's primary capital going into the business as opposed to buying out or buying off. At that point, you may have some dilution, but that's not a extraordinarily common transaction.
Okay.
Right?
Are there there's got to be some absolute horror stories out there of people who just got washed out and they didn't do anything wrong per se. They just didn't know how it worked.
I'll give you a horror
absolutely.
story. Here's the worst horror story. You have folks that get diluted from control to non-control. So they've got 49% of the business and they control nothing, and they can't get their money out. So they end up going, oh, well, I'm a founder. I've built a really nice business. It might be doing, 7 million, 8 million of EBITDA. I'm going to come in, and I know I need some additional equity. So I'm going to come in and you raise a $50 million of primary equity to come into the business. And in return, you're giving up 51% or 60% of the business to do that. And then 6 months into it, the VC goes, you're not the right executive for us. We want somebody different. You're you're out.
Yeah.
Nothing you can do except your entire net worth is stuck in that
Tied
business.
up in that business.
You're likely stuck with a board seat that doesn't have any control, which makes you a fiduciary of the business, so you can't compete. You can't. I mean, you could end up like that's the horror story.
Yeah.
There's a horror story where like my business is distressed, and I get diluted down to zero essentially because of cap stack. They throw on a preferred, or they throw on
Down
stuff
to
above
zero,
you.
though?
Down to zero, effectively economically down to zero.
Yeah.
But that's almost better than to be stuck at like 49% and not have any control and have all your money tied up and you can't compete and you're stuck kind of sitting on the sidelines. That to me is like, that's horrible.
Yeah.
And I've seen that. I've also seen folks diluted down to zero because they basically were in distress and they said, yeah, we need additional capital. And they said, look, we'll put additional capital in. It's going to be, preferred. So it's good. So you can have your common all you want. It kind of comes back to the capital stack discussions we talk about in our book or on a few of these other podcasts, where they may have, from a common stock perspective, they may not experience dilution at all. They may hold all the common stock still, but economically they've been diluted.
May never see the light of day. Yeah.
So there's kind of like, there's different levels to think about this on. It's not just the financial, although that's important to a lot of people. You mentioned like the voting rights and the control, like you have influence, you have a say, you can make decisions versus like, I may be the founder of the company, but now I'm like a bound pigeon. I can't do anything.
That's it.
Because
That's it. This is your baby that you're now basically relinquishing and watching somebody else raise that baby into a child or taking it. I mean, a lot of times what I see with founders is when that happens and they give up control, it's like the business goes a completely different direction or something like that. And that is the hardest thing for them to deal with because they conceived of it. They, got it to a certain point and now they can really do nothing more about it because of the way they've been structured out of the business. But alas, there are ways in which you can avoid being diluted. Sometimes it's costly, of course. You can have preemptive rights to contribute more capital in later rounds so that you can keep a proportional share. Now, easy for somebody to say, but if you're not a billionaire or something like that already, and you're raising another large funding round, that's hard to kind of keep up with. So there's levels of practicality to that.
But how would that work, just in theory?
Well, let's say you have a 50% position in your business today, and you need to raise another $50 million. That would mean that you would need to put up the next 25 to keep that position, basically, to maintain 50% ownership. So that's real simple math, but you can imagine with big numbers, that means you actually have to come up with a lot of capital yourself.
Start writing a check.
Yeah. Is there any clause or any preemptive thing you can do where I get to retain my percentage and then I have to buy it, but at like a cheaper price? Like
everything's negotiable.
Everything is negotiable.
But those negotiations are premised on your leverage, and your leverage is premised upon the condition of the business and how much you need the capital and how much competition there is to provide it.
So in the scenario where you're doing well and like investors want to be a part of it and you're like, okay, you can pay for it, you could set up like, okay, I'm going to let you in, but also just know that I'm going to retain my voting rights, I'm going to retain my share position, and I'm going to give myself the option to keep that share position at like a lower cost per share if it gets to that.
Now, you'd better be performing like, frickin' Mikhail Baryshnikov, and because you ain't going to be getting that kind of deal on a typical, even an atypical, that would be exceptional. That would be like once a decade type of deal you just talked about.
Yeah.
Okay.
Possible.
As saying funny names, but do we have like some success stories of like
'Cause I'm
how to
old.
do dilution well? Or like, hey, this is like, if you do dilution, this is how you want to do it.
I've got it.
Yeah, I mean, I think there's all sorts of success stories. I guess the couple that, we talked about a little bit earlier, Amazon and Facebook, and that comes down to those businesses having all the leverage. And so their founder owners basically maintain control and insane amounts of wealth through the process of taking all their money. The other thing I think it's worth talking about is this isn't just applied to folks that are founders or, have made initial investments, from a capital standpoint. Also, there's generally with a lot of these earlier stage businesses, there's employee pools of stock. So one of the things that if you're working for one of these and you get grants and stuff up front, you have to be thinking down the road to say, okay, how many other funding rounds are there going to be in this thing before the exit, which is what everybody's kind of building for. And you have to be careful, and you maybe try to ensure that the employee pool itself doesn't get diluted, right? Let's say an employee pool represents 15% of the stock at a certain point in time. For you as an employee that's got a vested interest in this stuff,
Yeah.
literally vesting interest, you want to make sure that employee pool stays at that 15% or greater. If you have leverage, maybe it becomes 20, who knows? But what you don't want to see is it become down to 5. So, your max grant is going to be, presumably less and less, and you're going to be working more and more, harder and harder the further this thing goes. So that's something to be really mindful of if you base your future outcome on stock-based compensation.
That's a really good point, because then your employees could just get totally just discouraged and like, all right, well, my
Now, typically, employees are what makes companies happen and makes things go for a business. So, it's fairly rare where I feel like even changing of the guard, bringing new investors, they don't want to see the employees, just like you say, totally pissed. So there's usually a balance to strike there, but it is just something to be mindful of. Is your own pot of things shrinking?
A lot of times what I've seen is you have the option pool
Yeah.
might stay at 10%. So it was
Yes.
10% before, but it's not, and it's 10% now. So you have new options.
Yeah.
Those new options are issued, but they're issued at the new valuation. So that way,
That's right.
the
Yep,
folks
that's
only
right.
get, kind of the ups from that point forward. So their original options are diluted, but they're at a lower valuation. So they've still locked in that value.
Yeah.
Locked in the value.
Yeah.
You don't really see it until you leave, and the exit happens. But they get the pool stays at 10%, but all the new options are at the new higher valuation. So you've got to earn those.
It's all about timing. I'm like just chuckling to myself here, being reminded that, a company I worked for at one point in time, I joined the company and I was really stoked because I got options in it and stuff. But then I later learned that my strike price on my options went up like almost 4x what it was like the month before the company got revalued from a much lower valuation. So had I started earlier, I'd get at the exit, which did happen. I would have gotten like 4 times.
Oh no.
It's I love it. It's how it goes.
Timing is
One
everything.
of these days, I'll end up on the right side of those deals.
Timing is everything in lots of areas of life. Yes.
It is. Yeah.
Just out of
Yeah.
curiosity, is there any way that a share would get, what is the opposite of diluted? Concentrated, where it actually be worth more?
I haven't seen a lot of that. You do have situations where you can have share buybacks. I mean, you see that more with public companies where they've
For
got
sure.
excess cash and they go, okay, we're going to buy back some equity. You can see that sometimes, I suppose, in like a private equity setting where you retire preferred. So it may be convertible preferred that gets retired, and then with cash, and then your common stock, now that you don't have those conversion rights hanging out there, ends up more concentrated. But it's rare because, again, who's going to be the seller? The time where you might, at the concentration point. So where you would tend to see it is more the people leave. I mean, this is one that I have seen over and over again. So kind of on the flip side of that is you have a 10% employee pool that's all been issued. So that means the other folks have a 90% interest. And then all those employees quit, get fired, whatever, and now you're down to 4% of the employee pool they don't reissue the other 6%. So that means that essentially concentrated the balance, but it's normally not that's around the margins, and that's fairly typical that you've got an employee pool that's not fully out invested.
The point here is that it's also fungible, and like over time, these things, move around a lot. So you just need to know what levers to watch out for and to think about, so that you'll understand what's at stake at every point in time when you're getting a new round of funding or something like that. Structure means everything. And I think like the balance of strike, right? If you're a founder, perhaps, and you're thinking about whether to take on capital or not, let's say in a scenario you could somehow maintain your control, you just really need to think about, okay, the whole point of taking on more capital is to expand the size of the pie. Well, if I expand the pie, and even if my slice of the pie gets smaller, will I be better off in this scenario or not? Assuming, you like the partner and all this other stuff, you just have to think economically and say, okay, does taking on more money lead to an overall better outcome, even if I have less of a share in the company? And I think, because when people take on most rounds of funding, that's what they come to the conclusion of. It's like, yes, that was better for me. That was better.
Yeah, the additional funding, the additional cash reduces the risk premium.
There you go. There we go.
Almost
Risk
got
premium.
the whole episode.
I had to get risk premium in. I've been waiting.
We're gonna turn this into a drinking game.
Our subscribers are going to have the risk premium drinking game. Every time Ed says risk premium, take a drink.
True. Yeah.
As you go through the rounds of funding, who is the one making the decision of whether or not to dilute the shares or not? Is it like the majority party?
It's the board
of directors.
But it's like the majority.
Effectively, but it's the board.
Yeah.
So again, you could have a situation where the majority, use a Facebook example, the majority could not have a majority of the board because they don't have a majority of the votes. They've got a majority of the equity. Mm-hmm. And so it's the board of directors makes that decision.
Yeah.
Now, again, the board of directors is tasked with fiduciary responsibility to make the company perform as best it can and to act in the best interest of the company, which includes the shareholders. Yep. So, there's
typically founder and or CEO is, not only on the board, but typically the chairperson of the board too. So, you have representation at that level from the operating business as well as other investors and outside.
But that's where, in the example we gave earlier, where founder maybe gave up the financial shares but kept the majority of the voting rights, then that founder could decide, we're actually not going to dilute this further because I'm going to vote against that.
Or unless I'm going to get certain terms, we're not going to proceed with
Are there any other levels to think about? There's financial voting rights. Are there other kind of levers to pull?
Well, before we do that, I just wanted to connect this back to a really important thing. If you're a founder, it's worth not getting screwed by working with an advisor to help you think through these things, because again, oftentimes you're dealing with professional investors that all they do every day is manipulate cap tables to their advantage. And I think some of the horror stories we could drum up have to do with founders being naive or being told something that when you look at the fine print, it's not what it seems. So as we've talked about in our book, and strongly advise here is get a circle of trust around you, whether it's legal advisors or financial advisors, et cetera, that can help you navigate the complexities of cap tables. I'm a CFO, for crying out loud, and these things are complex and sometimes make my mind, bend. So it's worth the time, it's worth the money, it's worth the peace of mind knowing that you got somebody else looking at it with you that has your interest at heart, because you're paying them likely.
Yes. All right. Exit question time.
Ooh, okay.
Let's do a couple rounds, lightning round here. Finish this sentence. You're about to get diluted when
you're running out of capital and you're needing to go ask for more.
There's an LOI on the table.
You're right. It's that simple. Yeah. Especially if you haven't already negotiated it, but yes.
If equity dilution were a dating relationship, what stage would it be in? The honeymoon, the breakup, or the complicated middle?
If equity dilution was? Oh, it's the complicated middle. It's actually worse than the complicated middle. It's like the we don't want to talk to each other part of a relationship, but I'm stuck in it.
Mediation, pretty much. Yeah.
Gosh. All right, last one here. Dilution in 3 words. Go.
Three words.
Must be managed.
Yeah. Avoid if possible.
But could be
Bootstrap
good.
forever. That's
Could be
only
good.
2 words, actually.
CFO can't count.
Bootstrap forever, damn it.
You could hyphenate bootstrap and stretch it
Yeah.
out if you needed
Yeah.
to.
No,
All right.
I'm very familiar with, capital markets and, different types of the cap table. But at the end of the day, I am just going to say, just fund it all yourself if you can. Don't worry about the other stuff. Maybe take on some debt and make that efficient for yourself. But,
Beautiful.
just fund it yourself.
All right. And now we know more about dilution.
You do.
Awesome.
Yeah.
Thanks, Ed. Thanks, Rory. Catch you
Thank
next
you.
time.
Yeah, talk soon.
Thank you.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.